Today, household finances and the RBA, both under the microscope. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I want to discuss the latest speech from the RBA on household finances. And by the way, if you value the content we produce, please do consider joining our Patreon program, where you can support our ability to continue to make great content. Here is the link, and it's also in the comments below. RBA Assistant Governor of Financial System, Michelle Bullock, discussed household debt and concludes that household debt in Australia has risen substantially relative to income over the past few decades and is now at a high level relative to international peers. This raises potential vulnerabilities in both bank and household balance sheets. While the risks are high, there are a number of factors, she says, that suggest widespread financial stress among households is not imminent. It is nevertheless an area that they continue to monitor closely. She showed that housing debt is the main issue, and that the risks vary across households and income bands, and that on an international comparison basis, we are right up there. Household debt to income ratio has increased more than for any other countries. Also, she cites HILDA data up to wave 16. The fieldwork for this report was conducted between 2001 and 2016, so not very current in my view. Perhaps the current risks are higher thanks to continued poor lending practices, flat incomes and rising costs, and our mortgage stress data suggests this to be the case. Anyway, this is what she said. Household debt in Australia has been rising relative to income for the past 30 years. Total household debt to income for Australia from the early 1990s has risen from around 70% to around 190%. There are three distinct periods. The first, from the early 1990s until the mid-2000s, saw the debt-to-income ratio more than double to 160%. Then there was a period from around 2007 to 2013 when the ratio remained relatively stable at 160%. And finally, since 2013, the debt-to-income ratio has been rising again, reaching 190% by 2018. Australia has not been unique in seeing debt-to-income ratios rise. The median debt-to-income ratio for a range of developed countries has also risen over the past 30 years, but the Australian debt-to-income ratio has risen more sharply. In fact, Australia has moved from having the debt-to-income ratio lower than around 2/3 of countries in the sample to being in a group of countries that have debt-to-income ratios in the top quarter of the sample. This suggests that there are both international and domestic factors at play when it comes to debt-to-income ratios. And then she went on to say that there are two key international factors that have tended to increase the ability of households in developed countries, including Australia, to take on debt over the past few decades. The first is the structural decline in the level of nominal interest rates over the period, partly reflecting a decline in inflation, but also a decline in bank interest rate margins as a result of financial innovation and competition. With lower interest payments, borrowers could service a larger loan. And the second is deregulation of the financial sector. Through this period, the constraints on bank lending were eased significantly, allowing credit-constrained customers to access finance and banks to expand their provision of credit. But as noted in Australia, the household debt-to-income ratio has increased much more than many other countries. The increase in household debt over the past few decades has been largely due to a rise in mortgage debt. And an important reason for the high level of mortgage debt in Australia is that the rental stock is mostly owned by households. Australians borrow not only to finance their own homes, but also to invest in housing as an asset. And this is different to many other countries, where a significant proportion of the rental stock is owned by corporations or cooperatives. There is a clear tendency for countries where more of the housing stock is owned by households to have a higher household debt-to-income ratio. This high level of household debt relative to income raises two potential vulnerabilities. First, because mortgage lending is such an important part of a bank balance sheet in Australia, any difficulties in the residential mortgage market could translate to credit quality issues for banks. And since all of the banks have very similar balance sheet structures, a problem for one is likely to be a problem for all. This graph shows the share of banks' domestic credit as a share of total credit over the past couple of decades. Australian banks have substantially increased their exposure to housing over this period, and housing credit now accounts for over 60% of bank loans. So the Australian banking system is potentially very exposed to a declining credit quality of outstanding mortgages. The risk is that difficulties in the residential real estate market translate into stability issues for the financial institutions. However, this appears to be currently low, she says. The Australian banks are well capitalised following a substantial strengthening of their capital positions over the past decade. And while lending standards were not too bad to begin with, they have nevertheless tightened over the past few years on two fronts. The Australian prudential regulator, APRA, has pushed banks to more strictly apply their own lending standards, and APRA has also encouraged banks to limit higher risk lending. Lending at high loan-to-value ratios has declined as a share of total loans, providing protection against a decline in housing prices for both banks and households. And for loans that continue to be originated at high loan-to-value ratios, the use of lenders' mortgage insurance protects financial institutions from the risk that borrowers are unable to repay their loans. However, she said, overall, arrears rates on housing loans remains very low. But the second potential vulnerability from high household indebtedness is that if there were an adverse shock to the economy, households could find themselves struggling to meet the repayments on these high levels of debt. If they have little savings, they might need to reduce consumption in order to meet loan repayments, or, more extreme, sell their houses or default on their loans. And this could have adverse impacts on the real economy, for example, in the form of lower economic growth, higher unemployment, and falling house prices, which could in turn amplify the negative shock. So what does the data tell us about the ability of households to service their debt? Well, the mortgage debt-to-income ratio shows the same pattern as total household debt-to-income, rising up until the mid-2000s, then steadying for a few years before increasing again from 2013. The dashed line represents the total mortgage debt less balances in offset accounts. This shows that taking into account these buffers, the debt-to-income ratio has still risen, although not as much. So households in aggregate have some ability to absorb some increase in required repayments. And in terms of serviceability, interest payments as a share of income rose sharply from the late 1990s until the mid-2000s, reflecting both the rise in debt outstanding as well as increases in interest rates. Interest payments as a share of disposable income doubled over this period. But since the mid-2000s, interest payments as a share of income have declined, as the effect of declines in interest rates have more than offset the effect of higher levels of debt. Indeed, even total scheduled payments, which includes principal repayments, are lower than they were in the mid-2000s, as the rise in scheduled principal as a result of larger loans was more than offset by the decline in interest payments. The risks nevertheless remain high, and it is possible that the aggregate picture is obscuring rising vulnerabilities for certain types of households. Interest payments have been rising as a share of income in recent months, reflecting increases in interest rates for some borrowers, particularly those with investor and interest-only loans. Scheduled principal repayments have also continued to rise, with a shift towards principal and interest rather than interest-only loans. There are therefore no doubt some households that are feeling the pressure of high debt levels. But there are a number of reasons, she said, why the situation is not as severe as these numbers suggest. First, the economy is growing above trend and unemployment is coming down. While incomes are still growing slowly, good employment prospects will continue to support households meeting their repayment obligations. And second, as noted earlier, households have taken the opportunity over the past decade to build prepayments in offset accounts and withdrawal facilities. In fact, despite the continued rise in scheduled repayments, actual repayments relative to income have remained quite steady, as the level of unscheduled repayments of principal has declined and offset the rise in scheduled repayments. Third, as noted earlier, lending standards have improved over the past few years, resulting in an improvement in the average quality of both banks' and households' balance sheets. Much slower growth in investor lending and declining shares of interest-only and high loan-to-valuation lending have also helped to reduce the riskiness of new lending. And at the insistence of the regulator, banks have been tightening their serviceability assessments. And in addition, strong housing price growth in many regions over recent years will have lowered the loan-to-valuation ratios for many borrowers. As noted earlier, arrears rates remain very low. Now, the discussion above has focused on the average borrower. But what about the marginal borrower? For example, will the tightening standards result in some households being constrained in the amount they can borrow, with flow-on effects to the housing market and the economy? Well, she said, our analysis suggests that while we should remain alert to this possibility, it seems unlikely to result in a widespread credit crunch. The main reason is that most households do not borrow the maximum amount anyway, so will not be constrained by the tighter standards. While the changes to lending standards have tended to reduce maximum loan sizes, this has primarily affected the riskiest borrowers who seek to borrow very close to the maximum loan size, and this is a very small group. Most borrowers will still be able to take out the same sized loan. It's also been suggested that the expiry of interest-only loan terms will result in financial stress as households have to refinance into principal and interest loans that require higher repayments. Again, this is worth watching, but borrowers, she said, have been transitioning loans from interest-only to principal and interest for the past couple of years without signs of widespread stress. Our data, she said, suggests that most borrowers will either be able to meet these higher repayments, refinance their loans with a new lender, or extend their interest-only term for long enough to enable them to resolve the situation. There appears to be only a relatively small share of borrowers that are finding it hard to service a principal and interest loan, which is to be expected given that over recent years, serviceability assessments for these loans have been based on the borrower's ability to make principal and interest repayments. So far, the evidence suggests that the transition of loans from interest-only to principal and interest repayments is not having a significant lasting effect on banks' housing loan rates. But an important aspect of considering the risks inherent in household debt is the distribution of that debt. If most of the debt is held by households with lower or less stable incomes, for example, that will be more risky than if a substantial amount of debt is held by households with higher or more stable income. In this respect, the data suggests that we can have some comfort. This graph shows that the shares of household debt held by income quintiles, the bottom 20% of incomes and the next 20%, and so up to the top 20% of incomes. And it shows how these shares have changed from the early 2000s until 2015, the latest period for which the data is available. Around 40% of household debt is held by households that are in the top 20% of the income distribution, and this share has remained relatively steady for the past 20 years. Furthermore, households in the second highest quintile account for a further 25% of the debt. So in total, 2/3 of the debt is held by households in the top 40% of the income distribution. Nevertheless, around 15% of the debt is held by households in the lowest two income quintiles. Whether or not this presents risks is not clear, she said. Retirees are typically captured in these lower income brackets, and if this debt is connected with investment property from which they are earning income, it may not be particularly risky. And another potential source of risk in the distribution of debt is the age of the head of the household. As noted, a regular stable income is important for servicing debt, so people in the middle stages of their careers typically have better capacity to take on and service debt. The next graph shows the shares of debt for various age groups for owner-occupiers and how they've moved over the past couple of decades. Households in which the head is between the ages of 35 and 54 account for around 60% of the debt. But there does appear, over time, to be a tendency for a higher share of owner-occupied debt to be held by older age groups. In part, the growing share reflects structural factors like lower interest rates. More importantly, it's not clear whether the higher share of debt increases the risks that these households will experience financial stress. On one hand, it might indicate that in recent years people have been unable to pay down their debt by the time they retire, and if they continue to have large amounts of debt at the end of their working life, they might therefore be vulnerable. On the other hand, people are now remaining in the workforce for longer, possibly a response to better health and increasing life expectancies. They also hold more assets in superannuation and have more investment properties. This improves their ability to continue to service higher debt, and there is no particular indication that older people have higher debt to income or debt servicing ratios than younger workers. So while the economy-wide household debt to income ratio is high and rising, the distribution of that debt suggests that a large proportion of it is held by households that have the ability to service it. Nevertheless, this bears watching. Now, frankly, I think the RBA is hooking the shot in terms of, first, they recognise the risks of high debt, but then seem to bear no responsibility for the poor monetary policy and over-lending in the system. Frankly, I found this speech disappointingly missed the point, perhaps to avoid scaring the horses. And in particular, I find the argument that she posited that because interest rates are so much lower, that means that people can afford to borrow a whole lot more, really quite weird. Insofar as the lending standards and the lending guidelines should not take account of ultra low interest rates, but the long-term average at around 7 to 7.5%. And frankly, she underplays the bad lending practices and the fraudulent activity that's clearly in the system, as exposed recently by the Royal Commission and elsewhere. So I believe that she's put a really positive spin on the data. And unfortunately, my own analysis that I've presented before tells a rather different story. The bottom line is this: households have too much debt, they've been over-lent to, and many are now close to the wind when interest rates are very, very low. Ahead, we see interest rates going to rise, and we also see home prices on their way down. This is a very unfortunate set of circumstances. And whilst at the moment default rates are very low, there are significant risks ahead, and if default rates start to rise, this could then have a snowball effect on the banks. So I don't think that the RBA has done itself any great service in spinning the yarn that is presented here. As always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, do subscribe now by hitting the subscribe bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.